pattern we're going to talk about today works with all types of securities, whether it's stocks, futures, options, crypto, anything that uses technical analysis, this pattern works with. You may hear me refer to it as a stock or talk about stocks a lot. That's just because I primarily trade stocks, but this pattern works with all securities, all right? So a lot of times when we're performing technical analysis as new and advanced traders, we tend to pay too much attention to the smaller picture and not enough attention to the bigger picture, which is like the direction, the major direction of the stock, the trend, and major resistance and support levels. Sometimes new traders, and again, advanced traders, myself, we get FOMO and we like to enter a stock when it's up like 15 candles in a row, right? It's just running and running and we think, damn, this thing is getting away, it's getting away, I gotta enter. You enter when it's at highs, and the next thing you know, you're underwater or you lose on the trade, right? So today I'm gonna show you something else you can do instead. So here we go, let's get into this. Consolidations usually happen after big advances and declines in price. When a security moves too far or too fast, it needs to rest, right? It's a resting phase. It's a phase where sometimes the price may pull back and start to move sideways instead of continuing in the direction of the trend. Sometimes the sideways movement can be ascending, kind of like at an angle, right? It's not completely sideways, it's kind of just barely upwards, and sometimes it can be descending, slightly moving lower, but it is no longer just moving up, straight upwards, right? So a lot of times it's goes from straight moving upwards to either completely sideways, a little bit at an angle on either direction, up or down. All of these consolidations are known as separate patterns, like flag patterns, pennants, ascending and descending wedges, bases. But to just avoid confusion and not go over so much, we're going to just talk about the uptrending consolidation. All right, the downtrend is just opposite. A downtrending security is a security that's making lower lows and lower highs, and an uptrending security is a security that's making higher highs and higher lows. So let's say we observe a security moving higher on relative strength. Soon the security stops moving in the direction of the trend and starts to move sideways between 2 points. And as it moves sideways, we call that a range, right? The stock is now trading in a range between 2 points. After a balance of buyers and sellers has been reached, one side's going to eventually gain control. And when that side gains control, most of the time the security is going to travel back in the direction of the primary trend. Consolidations are some of the best ways to trade securities. They can help us to identify areas to buy a security that offer low risk and high reward, right? Because it gives buyers a new support level that they feel comfortable to place their stops underneath. As we start seeing these lows get bought up, we can clearly visually see that there is actual other buyers stepping in every time the stock comes to that area. So it makes it a little bit more comfortable to actually enter there, and it gives us more confidence, which helps us to hold on to the trade better. All right, without confidence, we really have trouble holding on to the trade and getting to that maximum target. So the first thing we need to see to begin to identify a consolidation is the security moving steadily in one direction, making higher highs and higher lows, preferably getting further away from its moving averages. The next thing we do when we have identified a security that has momentum and that is trending higher is we wait. We wait for the security to start developing a support and a resistance. So if the security moves higher, comes back lower, hits support, we don't do anything, we wait. Moves back higher, hits resistance, comes back lower, we wait. Hits support, starts moving back away from there. Okay, now we start drawing our trend line. We got two spots where the security has stopped and been bought up and moved higher off that area. They coincide with each other. Once resistance is formed, we start to draw the resistance, at least 2 taps. I personally want to see that security hit resistance at least 3 times. So you've got resistance 1, you come back lower, hit support, come back, you hit resistance, come back lower, hit support, come back to resistance, hit it, that's 3. Now I feel like we have a good range, a solid range that has shown us resistance and support confirmed, okay? So that's what I want to see when I start trying to identify the consolidation. Then we know we have a stock with momentum that has been moving farther away from our moving averages. It's a well-known stock. It has room higher to move. And now we see that it's consolidating within those 2 areas. We start to draw our trend lines and we wait a little bit longer to time it. There are things that go into trading these patterns that can help you. That can help you maximize your profits, minimize your losses, maybe minimize the mistakes you make. All right, so let's talk about some of these things. If you want to be trading securities where you don't have to wait as long for your profits, or you really want an answer if you lose or make money on the trade fairly quickly, right? If you want fast profits, then you're going to be wanting to trade securities with big average daily ranges. Okay, that means that during one session, you find the security that has an average daily range that is fairly decent. Now, that's usually over $1, okay, at least, or over 5%, 5 to 10%. It's really up to you. But securities that have bigger ranges are going to hit bigger targets and they're going to hit them faster. All right, the next thing you want to look at is volume. Volume is very important because it indicates an increase or decrease in buying or selling. It tells us how much interest there is in the security itself, right? It tells us if the interest is increasing or decreasing. If the volume is moving up every day, right, we can clearly see that something is going on with the security and there's more interest, there's more volume, there's more people trading the security now. So that indicates a good amount of interest. If we were trading the consolidation and we were looking for an entry and we saw that support was tested 3 times, and that last time that support level was tested, we had a huge increase in volume off that level, that's a good indication that security is going to travel back higher. Average daily volume and volume itself, it tells you how liquid the security is. So if you're trading a security that's got an average volume of like 200,000 shares or 2,000 shares, what's the chances you can get in and exit that where you want to, right? The spreads are usually bigger on lower volume securities. You have bigger slippage. A lot of weird things happen. So you want to pay attention to volume. You want to be trading stocks with a higher amount of volume so you can get in and out where you want and when you want to avoid big losses and to actually be able to hit your profit targets. Another thing is distance. Distance away from your averages. All right, this is often overlooked, especially by newer traders that just don't know how to use moving averages or don't trust them. When a stock moves very far away from its averages, a lot of times that stock is not going to move higher until those averages catch up to the price. The security moves up higher, let's say it moves to 100, its moving averages are still at $30. Most of the time, it's going to get too far away where people are not going to buy it. As the stock consolidates, that moving average starts to move up higher. And while the stock's sitting there in a range, developing support and resistance, the average finally catches up, and a lot of times that's where you're going to catch your move higher. So the distance between support and resistance, how tight is the range? All right, so in a consolidation, we want to have a tight range. We don't want to see a big, huge, loose range, right? Like, so if this stock is $100 and the range, the consolidation is from $100 to $50, we don't want to have a big $50, big wide range, right? If you enter when that is broken, a lot of times that big wide ranges, they're not going to travel very much further, right? They might break a little bit the price, but then they just fall back lower. So if you see a security it has a range, you want the range to be tightening. If it was a $10 range from the top of resistance to the bottom of support, then you want to see it go to like 9 or 8, then 7 or 6, and then the range tighten to 4 or 5, right? So as resistance and support develop, you want to see the range between the two become tighter. All right. The tighter the range indicates that the stock is ready to break out. Okay. If the range is not tightening, it's just so loose that oftentimes it will just fail. So that's another thing we want to look at. The distance between support and resistance. How tight is the range? Let's say the security has an average true range of $1. And let's say the security has already moved 90 cents during the session. And then you see a consolidation. It wouldn't be wise to take that consolidation long, because you're not going to have that much room to move according to like the ATR, right? If you're entering at the highs of that day's average true range, likely the stock is just going to reverse and the consolidation is going to fail. Same thing if you're looking at like the daily levels on the chart, right? So if you're entering long on a consolidation, the ATR of the stock is 90 cents. Let's say it's only moved 20 cents. So you have like another 70 cents to go. You enter long, but the daily level is at resistance. It's probably going to fail. And then what happens is, so you don't want to be taking that security long, even though the ATR has not been passed, because the daily level of resistance is probably right there. It could cause this consolidation to fail as well. Right, so where is your stop located? Do you have room to profit? And that goes back to looking at the bigger picture. Is your stop too wide so that you can't hit your target? If we enter at the low of the flag and we use such a wide stop that we can't hit our target at the top of that range, our target is beyond there, our first target, well then our stop is probably too wide. If we can't put the stop where we want to with hitting our target, so let's say we try to place our stop under the low of the range, but by the time we enter, it's such a big amount, will that security be able to hit the target after? Does it have some sort of catalyst to help it move outside of that range? What do the daily levels look like? Are you near support? Are you near resistance? All right, and then is your stop too tight that you might get smoked out of the trade, right? So your stop location is huge, because it tells you if you're stopped too wide or too low, and do you have room to hit that target. When resistance has been touched 3 or more times, I am more likely to consider that a valid support or resistance level. And I will not enter on a consolidation pattern until I see at least 3 taps of resistance. All right, so whether I'm entering lows, highs, or where I'm entering, I want to see these levels tested. Now, many times I will enter at support at the low of the range if support has already been tested multiple times. And then having patience. Okay, entering a trade before resistance is broken or before support is broken is entering on anticipation. Or before a pattern has been formed, you're entering on anticipation, hoping that the pattern is going to form, anticipating it's going to form and break out in the direction that you wish. Whenever you do this, you're decreasing your odds. The reason I wait for multiple taps of resistance or support or multiple tests is so that I can give myself more confidence and there's a higher probability of the trade working out that way. The best thing we can do to trade these patterns is use the criteria and use everything we can to increase our odds on the trade, identify the consolidation, find the best entry, make sure we have room to enter, and then when we think the consolidation has broken over that resistance, we enter the trade. Hope you guys enjoyed this video. It was good. It's been a while since I've been here, and I will try to make the next video come out a little bit faster. And I will see you later. Take it easy.